time for us to get some sound business and investment advice from our friends at the Unit Trust Corporation. In with us this week, we've got Akenathon Marcano. He is the Assistant Vice President in the Market Risk Department. We also have in with us, and this is her first time with us, so welcome to the First Up family. Aklima Beekhan-Maharaj. She is the Assistant Vice President for Marketing and Communications. Today, we're talking about managing your risk and how to basically ride the waters of investment. There are times when they're flowing smoothly. There are times when they can become a little choppy. We have our friends in the UTC to help us out. Thanks for joining us this morning.
Thank you, Jessime. Again, it's a pleasure to be here on this program. As you know, this is our ongoing series on investor education, and that's started since last year. And actually, we're happy this morning to discuss risk and return, which is a critical element of any investment plan.
Let's start with the word risk. Sometimes people hear the word risk and they
think it's a bad word.
But risk under a certain context is a good word.
Well said, Paul. Risk actually is what gives rise to the opportunity. So, for example, we speak about an investment having risk. That means that there's a chance it could go up and or go down. So when you have investments that offer you different types of risk and you bring them together in a portfolio, over time, that portfolio can give you a steadier pattern of return or steadier investment performance. Because when some investments don't do so good, others do well, and the overall impact is overall, should be positive overall.
The assumption being a diversified portfolio.
Exactly.
Aklima, let's talk about risk in the context of that diversified portfolio, because that is always the advice. Have a diversified portfolio, so when the riskier stuff may not be as stable, you have a proper solid foundation.
Okay, well, we always try to give some guidelines to our customers and to our potential customers. You do not put all of your eggs in one basket. In some instances, some of the instruments that are in a particular fund, let's say, maybe we may carry with it a higher risk, but that is to allow you to grow and to perhaps get a higher and improved return. In addition to that, what we try to tell our customers is that when you diversify your portfolio, you lower your risk, you improve your return. It helps you to build wealth faster.
So the bottom line, don't keep all your eggs in one basket, but there are some who would ask, how many baskets do I really need to have, or how big should my basket be, in terms of all the eggs that I have to juggle?
That is all reliant on what your financial goals are. In the first instance, we always ask our customers and our potential customers as well to identify your goals. And within identifying your goals, you need to set time frame. So I may have, let's say, someone may want to get married in the next 2 years. That might be a medium-term goal. Someone may have a retirement goal, a long-term, over 5 years. And what we try to let them know is that if you have more time to invest for your retirement, it actually gives you the ability to beat the effects of inflation, so that your basket of eggs should actually, the more diversified it is, it will enable you to beat inflation. It will also have, you can actually, over time, you can have compounding of interest depending on the fund that you have, So in that area, you can actually look at the eggs, or different eggs in a basket, but it helps you to combat inflation at the end of the day.
And the formula regarding the juxtaposition, the ratio of high risk versus low risk accounting also depends on one's age and goals, because certainly someone further down the age bracket, 50, 60, would have a different type of portfolio compared to someone who's 20 and now starting off and has more time.
Generally, that's true. That's quite correct. And the simple reason is that time, we have a proverb, time heals all wounds. Well, time allows portfolios to weather, the different cycles of financial markets and economies. So, in general, yes, someone who is younger has more future paychecks to collect. They ought to have a higher tolerance or capacity to bear risk. And so therefore they can invest in instruments that tend to give you higher potential for capital growth, for capital appreciation, i.e. stocks. But whereas if you compare that to someone who's approaching retirement, where basically they'll have a fixed, and limited income going forward. They would probably want to be in more stable investments that have more predictable returns, and therefore that allows them to have certainty of income during their golden years. But I want to say something more about age. It is possible, depending on your wealth position, that you could be older and still have a higher risk tolerance, or you could be younger and have a lower risk tolerance. So each investor is an individual, and we need to always understand where they are at a point in life and what their goals are, their financial goals are, and that will inform the discussion about risk and what is the right ratio of high risk to lower risk investments.
And I guess by extension what one's assets are, because if you're later on in life and you don't have a mortgage to pay,
right,
you have those assets put aside, you can be more risks. You can take more risks sometimes. You have a higher risk tolerance.
Correct.
So at the end of the day, your wealth position will determine, regardless of your age, will determine how much risk you engage in.
Well, it's one factor. It's not the only factor. Your risk tolerance really is a combination of different things. So, for example, your wealth position will be one. Your own sort of psychological makeup, how you deal with bad news, for example.
If you're a risk averse, your tolerance
that comes into there. And as I said, your income earning power going forward. So generally, a younger person will have more income earning power over his lifetime than someone who's older.
We're with our friends from the UTC giving us some sound investment advice. They will be taking, we take a break for the news and we come back with them to get more information. Stay with us right here at First Step. Welcome back to First Up. It's just after 8 o'clock. We now have our word for the day, and our word for today is insidious. It's a word of working or spreading harmfully in a subtle or stealthy manner. Insidious rumors or an insidious disease like pancreatic cancer is an insidious disease because it sneaks up on you. And by the time you diagnose it, it's basically too late. Ask Steve Jobs.
Yeah.
Isn't he pancreatic cancer also?
Mm-hmm.
Yep. Mm-hmm. So
it snuck up on him.
You have to look out for those insidious diseases. All right, welcome back to our final segment here. We are talking about risk and return with our friends from the Unit Trust Corporation, Akenathon Marcano, Assistant Vice President, Risk Market, and also Aklima Beekhan-Maharaj. And Aklima means knowledge. So she's credible. She's the Assistant Vice President, Marketing and Communication. So we've kind of put into context what different age groups and earning levels can afford and where they should be looking in terms of risk. Why keep investing? That's another question that's always stuck in my head, because you have a particular portfolio. How often should you look at that portfolio with a view to possibly adding or subtracting, evolving it, and why keep investing?
Basically, people keep investing to build wealth. But even more so, you keep investing to combat the effects or to beat the effects of inflation. The thing about it is that whenever you may be investing towards an emergency fund or let's say to retirement, and you want to ensure that you reap the rewards of compounding interest. Let's say you're investing in a particular instrument that has a fund that has compounding interest. So you keep investing basically to accumulate your wealth, to ensure that if there's an emergency, you have the income there, and you want to also invest for the longer term. You want to beat inflation so that when you stop working, you're quite able to subsist yourself and enjoy a certain standard of living.
It is ready to bolster your fortunes.
Correct.
For the future and for current everyday living.
Yes.
There are some who would argue that, well, young people aren't thinking in those terms at all because they assume that they have their whole lives ahead of them. They don't expect to have too many emergencies because they have health and strength, so they can work and build that wealth up. But it's critical that you actually start that journey to wealth accumulation as young as possible, isn't it?
That's correct. The more time you have, the faster you can grow your returns. You can have better returns. The more time you have available for investing, the more you can beat inflation. You see, inflation is I have to say it really eats away at the value of the dollar.
It's insidious.
Correct.
Yes. Inflation is insidious.
Yeah, it eats away at the value of your dollar. So you might be 20 years old, you expect to retire at 60, so you have 40 years ahead. If you do not start immediately, what you will do is negate your opportunities or your chances of beating inflation. You want to think in the future. You have retirement, you can get ill, you have to look towards that. So as soon as you start working, we always try to give some guidelines to our young customers as well. You start putting aside something towards your future, your retirement. When you retire, you get 2/3 of the amount of money that you've been working, your salary. So you have to have some cushion to facilitate that 1/3 that you will not be able to receive when you stop working. And so it is very critical that you start. Don't procrastinate. When you're at an older age, let's say you're more into your 50s, you have 10 years to retire. It means that the amount of money you can now dedicate towards preparing for that, for your future, it will now be a large amount that you have to put aside,
Because you have less time.
Correct.
But in today's world, many people, they may retire from one career and then start another career, if they're retiring at 55 or at 60, they may have many years of productivity left in them and they may do something else or finally open that business that they were dreaming about. Let's speak to those people then.
Well, again, at every stage of your life, you should be assessing your financial goals. And so, I mean, someone who approaches life that way, they may be working for one reason because, they like to work, they're enjoying their field and they want the opportunity to stay active. But in terms of financial goals, they may be looking at building a legacy for their family, for their children or their grandchildren, as the case might be. And that's a financial goal. So at the end of the day, yes, their investment portfolio decisions may be different from somebody who is gonna stop at 60 and go on cruises and so on. But it is still a discussion about financial goals. What do I want to achieve? What do I want to leave for my children or my grandchildren? And therefore, even when they continue with that second job, then they should also have an investment plan that comes out of that job. So they will also have to do the same discussion in terms of how much paychecks do I expect going forward? What percentage of these paychecks can I put aside to build or supplement my investment portfolio? What are my investment objectives? What financial goals I want to achieve? And so on.
So at any stage, it's still about goals, time frames, and accomplishments. Thank you very much for being with us. We run out of time. We've been talking to Akenathon Marcano, Assistant Vice President, Market Risk, and also Aklima Beekhan-Maharaj, Assistant Vice President, Marketing and Communication. Is there an Assistant Vice President post for me? We'll take a short break. When we come back, we will be talking to our Attorney at Law and Commissioner with the Police Service Commission, Martin George. Stay with us.